Think back to the good old days when the most important thing that kept us from buying a home was probably your income. That's what we thought about the most. Today that has shifted. It's now actually the down payment. And in this video, I'm going to look at why more than a third of Canadians say that saving for down payment is the number one reason that they're stuck renting and what that means for the future of home ownership here in Canada. A new survey out, it shows that 1/3 of Canadians, about 32%, say that saving for a down payment is the biggest reason that they can't buy a home. They cite raising rent prices, slow wage growth, and a high cost of living that are making it tough for a lot of people to even consider breaking into the market. Now, just 10% of those surveys said they preferred renting rather than owning. So that says that most Canadians obviously are still, seeing home ownership as a key financial goal, even if it feels increasingly out of reach for so many. Now, Li Zhang, financial literacy leader at CPA Canada, says, I think the main takeaway here is affordability is becoming a real problem. It goes beyond housing. You start looking at what the majority of respondents are saying in that they're really struggling with the cost of living. The survey results also show that affordability is affecting nearly every aspect of people's finances, not just housing decisions. Now, on this topic, though, mortgage payments, of course, are also still a major hurdle. 30% cite them as a main barrier. On top of that, 43% of respondents say that the high cost of living overall is their biggest financial stress. David Alexandre Broussard, chief economist at CPA Canada, he says high down payments restrict access to real estate investments and exacerbate wealth inequality, leading to social consequences. So a lot of people are just caught in this financial squeeze that limits both their ability to buy property, and then of course that ties into building long-term wealth. The data shows that there is a stark generational divide in home ownership also. 74% of Canadians over 55 own their homes, but that number drops to just 31% for those who are aged 18 to 34. Now, Zhang says here, homeownership is closely tied to financial stability and wealth accumulation. This is reflected in the behavior of Canadians. Homeowners are more likely to save for retirement and invest, while renters often live paycheck to paycheck. Renters are often focused more on covering their basic expenses, so any long-term financial planning becomes almost impossible. Now, I want to stick with housing problems, and there's a big one in Toronto with the condo market sitting on just a pile of unsold units, and it seems like that's only growing. Ron Butler, he's the principal broker at Butler Mortgage, and he says it has reached an incredible level. We have about one full year's inventory, and that seems to continue up and up and up in terms of listings. There's really no sign that it's going to level off or that there's going to be any reduction in the near term. Now, overbuilding here has been the main issue, especially with small units that were designed more for investors than for everyday families. And these investor-targeted units, they're often less than 500 square feet. They're not really appealing to most buyers. Butler says here, it's weird that in a country like Canada, where there's been a consistent housing crisis for the last 10 years, that if you build a very bad product, people won't take it. It's as simple as that. And he explains that many of these condos are the size of large hotel rooms that simply don't meet the needs of families that are looking for what he would call a real home. Now, one of the more troubling stats here, about 30% of condo deals in Toronto are now actually falling through. Now, Butler says here, some of these people will be litigated, but developers let the rest of the condo units close. And then a few months later, they start selling the other units that didn't close at a substantial discount into a weak market with more and more inventory pouring in all the time. This kind of churn is just flooding the markets. It's pushing prices down even further. Now, Toronto isn't alone here. Specifically, markets in Surrey, British Columbia, and Calgary are also showing cracks. In BC in particular, there's pricing expectations that are way out of sync with reality. And when there are units that are just down the road selling for a quarter of the price less, people are making the decision to just move on and take a pass. Now, I'm not sure how I'm going to make this next story sound remotely interesting, but it is important. It gives us a pretty clear picture of how Trump's tariffs are affecting Canadians. So I am going to give it a go here. Hopefully you can stick with me just for a few more minutes. Talking about Canada's trade deficit, and it just got smaller, but not for the reasons that you might necessarily think. In March, Canada posted a trade deficit of $0.51 billion, and that's a reasonable improvement from February's $1.41 billion shortfall. Now, on the surface, that looks like a step in the right direction, right? A smaller deficit, that's good. But if we dig a little bit deeper into this and we see that it wasn't driven necessarily by the things that we would normally like to see, things like growing exports or booming global demand, that's generally the type of data that we'd like to see coming in. But in this case, it came from a sharp drop in imports and especially from the United States. No big surprise there. When I look at exactly what happened, imports, they fell by 1.5%. That was at 70.4 billion. That's the first monthly decline since September. And it's a pretty big deal. It wasn't a broad-based slowdown. It was very targeted. The biggest drops came from metal and non-metallic mineral products. They plummeted 15.8%. Energy products were also down 18.8%. Why did this happen? Well, of course, it's because on March 13th, Ottawa slapped a 25% tariff on U.S. goods, and that was the response to the new American levies on Canadian exports. So that's where we're going now. Also, Canadian retailers, households, they also pulled back on U.S. products voluntarily, and that adds a layer of economic nationalism to the mix. Imports from the U.S. alone dropped 2.9%. Now, on the export side, the picture was a bit more stable, not exactly strong though. Total exports dipped slightly, down 0.2% to $69.9 billion. The exports to the U.S., they dropped 6.6%. That's hit hard, of course, by those American tariffs, especially on Canadian metals. That hurt quite a bit in this report. Now, here's an interesting twist. Sales to non-U.S. countries, they jumped 24.8%. So that is a massive jump there. And clearly Canadian exports are already starting to pivot to new markets. There were some sectors that did still struggle. Metal, mineral product exports dropped 3.2%. Consumer goods fell 4.2%. So the tariffs here were clearly a factor, especially in the sectors that are more closely linked to U.S. trade. When you look at all this in aggregate, what does it tell us? Well, the trade policy is starting to take effect. It's starting to take a bite. You just can't ignore that there's this rift that's growing between Canada and the U.S. These are two of the world's most integrated economies. When you look now at the Bank of Canada, the U.S. Fed, this is further complicating things, probably the last thing they need. On one hand, you've got the narrower trade deficit that might be welcomed by those who are focused on the headline figures. But on the other hand, you've got the underlying cause, a contraction in imports due to the higher costs and the strained trade relationships that could be a sign of trouble ahead. So for the Bank of Canada here, it's kind of the last thing they need, but it does introduce more uncertainty, and there certainly has been plenty of that. If these tensions stick around for a while, they could dampen consumer choice, they would raise prices, and that would also weigh, obviously, on business investment. For the markets, as investors, the key takeaway is risk. If we see a long trade standoff with the U.S., that would do things like it would reshape the supply chains, it would disrupt corporate earnings, it would drive more volatility, especially, again, for those countries that are tied on cross-border flows. The biggest question here, are we looking at a temporary flare-up, or are we in the early stages of something that's more permanent, like a permanent decoupling of the relationships here? Like I said, one of my key takeaways from this whole report is that sharp pivot that we saw to non-U.S. export markets, and you just have to wonder if Canadian businesses just sort of hedging bets right now, or are we actually in the middle of, are we witnessing a big, huge structural shift? Consumer behavior, saw the same thing there, right? If Canadian households continue boycotting the American goods, even if it's informal, that could just amplify the trends that we're seeing right now. Obviously, we will be looking for any de-escalation or perhaps escalation in the trade dispute. That will tell its own story as this all plays out. Personally, I hope that cooler heads prevail. Last point here, I want to keep an eye on inflation. You've got tariffs now baked into the import prices. So we're probably going to see some upward pressure, especially in these categories like metals, consumer goods, and that would just complicate the bank's path forward on interest rates. I am curious what your take is. Leave a comment below and subscribe if you'd like to keep following with this type of information. As always, I do thank you for watching. We'll see you in the next video.